From a common perspective, company means an association of persons formed for the purpose of carrying on a business. But for a comprehensive meaning, we can take definition given by Justice Lindley, who says it is an association of persons who contribute money to the common stock and carry out business and share the profit or loss. The common stock is called capital of the company. The contributors are known as members, and the proportion is represented by a share which is transferable. Companies Act 2013 defines a company under section 2 subsection 20. It says a company is one which is incorporated under this act, that is Companies Act 2013, or any previous company law. Incorporation is the legal process of bringing a company into existence. Any previous company law has three components: 1850, 1857 and 1956. 1850 is the first law on registration of joint stock companies. 1857 is first introduction of limited liability. 1956 is the first law after independence, and the latest act is Indian Companies Act 2013, which comprehensively covers both listed and unlisted companies across the country. An incorporated company has certain unique features. The first feature is it is a separate legal entity. It's an artificial person existing in the eyes of law and can do everything like a natural person, except a few acts like singing, dancing, painting, etc. There is a classic case where Salomon versus Salomon and Company Limited. Salomon converted his business into Salomon and Company, and the company had three components of liabilities: shares held by Salomon, debentures held by Salomon's family, and unsecured creditors. When the company went into liquidation, unsecured creditors wanted to be paid out first, stating Salomon and Company are one and the same. Court disagreed with them, and it held company is different from its members. The second unique feature is limited liability. This concept of restricting liability to the extent of nominal value unpaid gave lot of security to investors who wanted to have their private property not exposed to the business risks, and this unique feature helped company to grow up as the most popular organizational structure for business. The third unique feature of a company is perpetual succession. It continues in spite of change in its members. Like a river where the water keeps changing, a river keeps its identity. This was held in Meat Supply Guildford Company case, where all members of a company died in an incident, and the court said life of the company is independent of the life of its members. Therefore, it keeps continuing. Company can have property in its own name under the feature of separate property. Its properties are not that of the member. In Makawara versus Northern Assurance Company, company's timber was insured by one of the shareholders who held majority of the shares. On the timber being lost, insurance company refused to pay compensation to the member for the simple reason the property was in the name of the company, not in the name of the member, and hence he cannot have an insurable interest. Common seal is the signature of the company. It has to be affixed following the procedure prescribed. There should be a resolution passed by the board or a committee of the board, and the authorized people have to sign off confirming that the stamp was affixed in their presence. Transferability of shares is another unique feature. There are two sections in the Companies Act. Section 44, which says shares or debentures are movable property and they are transferable as per provisions of the articles. But section 58 subsection 2 targets public company and says securities or other interest of any member shall be freely transferable. On the strength of its separate legal entity, a company can sue others and it can also be sued by others, but it has to be represented by a natural person. A suit like a suit for damages against defamation could also be filed by a company if any published material affects its business. In all, there are 7 unique features of a company: separate legal entity, limited liability, perpetual succession, separate property, common seal, transferability of shares, and capacity to sue and be sued. The unique feature of separate legal entity gives freedom to the operators of a company, and that freedom is granted to them by the corporate wheel. Who operates behind the wheel is not business of outsiders, but there are cases where the corporate wheel will be pierced. That will be mainly where separate identity is wrongfully used. There are two provisions. One, as per the Companies Act, where personal liability of directors and members comes to the fore for reasons of non-compliance of requirements of incorporation, misdescription of name, fraudulent conduct of business, etc. Second, even the courts, in the course of their judicial interpretation, pierce the corporate veil to find out the real person who is guilty. The first ground where courts lift the corporate veil is for protection of governmental revenue. Whenever there is a tax evasion, just like as it happened in case of Dinshaw Manekji Patit, where 4 private companies were used to show personal income as corporate income, the court lifted the veil and fixed responsibility on the individual who misused the corporate entity. Corporate veil is pierced in times of war to find out any alien enemy behind a company. It happened in case of Daimler Company Limited during World War I, where the English company had members and directors from Germany. Product was from Germany. When they started realizing debtors, the debtors approached the court and the court upheld the debtors' claim that they need not have to pay because it will be as good as funding an alien enemy which is against public policy. Where there are apparent acts of fraud or improper conduct, courts always lift the corporate veil to find out the personality behind the company. Just like in an instance of blacklisting a contractor who submits his bid in the name of a newly formed company, courts will see who is behind the company so that acts of fraud or improper conduct go punished. Where there are acts opposed to public policy, courts prefer to lift the corporate veil to find out the personalities behind the cloak. Example, to avoid welfare legislations, there is a bad practice of showing the staff strength at a lower level by splitting it between 2 different companies. In such case, the court will find out who are the promoters behind those 2 split companies who can be brought to book. And this is where the corporate veil is lifted. Any transaction that highlights an attempt to avoid legal obligations, courts prefer to find out who is behind the corporate veil. It happened in case of Guilford Motor Company Limited, where Horney, a person appointed with an undertaking that he will not entice away the customers and staff of his employer when he leaves service, he forms a separate company and through that company he violates this condition. Courts ignore the company which he has floated and they identify Horney to be the responsible person by lifting the corporate veil. Courts invariably go after the persons who are responsible, lifting the corporate veil in cases involving contempt of court. Be it a director, manager, secretary or other officer, he will be proceeded against and punished, disregarding the separate legal entity of the company. Thus, in all, there are 6 instances where corporate veil will normally be lifted: for protection of revenue, for identifying alien enemy, in cases of fraud or improper conduct, acts opposed to public policy where intention is to avoid legal obligations, and cases involving contempt of court. Main classification of companies is always on the basis of liability of members. If there is unlimited liability, it is an unlimited company. If the liability has got a limit, then it is a limited company. Limited company has 2 variants: limited by guarantee, where an amount is guaranteed to be paid on winding up. In respect of limited by shares, the liability is restricted to the unpaid value of shares held by a member. Companies limited by shares can take the form of a private company, which as defined in the Act should have a minimum capital of rupees 1 lakh and have 3 restrictions in its articles on transfer of shares, number of members and invitation to public for subscription. Companies Act uses the same definition to define public company in a different way. It states public company means a company which is not a private company. A public company can get its shares listed on a recognized stock exchange and it can be called a listed company. When the shares are not listed, the public company stays unlisted. A company may operate in India, but it might have been incorporated outside the country. Such a company is called foreign company and its Indian counterpart is known as domestic company. Some companies come into being by way of a legislation passed in the legislature or in the parliament, and they are known as statutory companies. There are companies where 51% or more of the shares are held by either central government or state government or a combination of them or any company floated by them. Such company is called a government company. In a company limited by share, the board of directors might be controlled by another company, or 51% of the voting power might be held by another company. In such a case, the company is known as a subsidiary company. In a company where the control is less than 50% but more than 20% of the voting power, it is a case of significant influence exerted, and such companies are known as associate companies. In both cases, the company which holds the control is known as a holding company. Private companies help small businesses by providing for a concept of small company where there is a restriction of maximum capital of 50 lakhs and maximum turnover of 2 crores. This is to help businesses prosper by taking governmental facilities. One more company form which is used mainly by SMEs is a special form of company known as one-person company, where an individual can form a legal entity for promotion of business by following certain restrictions, and one-person company is widely used by the technocrats. We have got one more form of company which is formed for the sake of promotion of objects such as charity, art, commerce, science, education, environment, religion. It can be formed by individuals, firms, companies, or a combination of them, but the restriction is they have to pay no dividend to any of their members and all their funds are to be used exclusively on the objects. Now, this is the way a company limited by shares takes shape and acquires so many features for the success of businesses. Understanding the two companies by elements is quite helpful. A public company needs 7 members minimum, private only 2, maximum no restriction in public but limit is 200 in private. Directors, at least 3 required in public, 2 will do, could be recruited by single resolution, no retirement by rotation in private. On appointment of directors, consent to be filed with ROC in 30 days and qualification shares apply for promoters. No requirement of filing in respect of private. Invitation to shares to the public, a public company can do, private company is prohibited. Transferability of shares, free transferability in public, restriction permitted in private. Quorum, depending on the total number of members for a members meeting. In case of private, 2 members form quorum. Managerial remuneration, not to exceed 11% of profits in public, no such restriction in private. Commencement of business after minimum subscription, but in case of private, immediately on incorporation, business could be started. Minimum paid up capital required for public is rupees 5 lakhs or higher. In case of private, it is rupees 1 lakh or higher. Further issue of capital to existing members only as per section 62, but the section allows private company freedom. Disclosure of interest is strict, not to participate or vote applies to interested director. No such restriction in a private company. Both public and private have their own relative strengths in respect of the 12 parameters, and because of these distinctions, businesses make use of them depending on their specific requirements for flexibility and growth. The legal process used to form a company or a corporate entity is called incorporation. The existence from the time of formation till winding up is represented by the concept perpetual succession. A company can acquire and transfer properties in its own name, meaning the property of the company is its own property. It is not the property of its members. As it is a separate legal entity, it can file a suit or someone can file a suit against the company and its own name will be used as a party in the suit. Only requirement is the company needs to be represented by a natural person. Wherever the separate identity is misused by persons in actual control, the courts pierce the corporate wheel and expose the people behind it and fix responsibility. Both the principle of separate legal entity and lifting of corporate wheel is clearly explained in the well-known case of Salomon versus Salomon and Company. Minimum 7 people are required to form a public limited company. The shares held in a company in the normal course, if it is a public company, is freely transferable. A private limited company will have minimum 2 members it can be formed with, and it will have a minimum paid up capital of rupees 1 lakh. Its articles will have 3 unique features. There is a restriction on transfer of shares, there is a limit on the maximum number of members to 200, and there is a prohibition on inviting public to subscribe to its share. What is an investment company? Whose principal business is acquisition of shares, debentures or other securities. What's a subsidiary? Subsidiary is a company in which a holding company controls either the composition of the board of directors or controls more than half of its voting power. Associate company is a bit short of subsidiary company. In a subsidiary company it is 50% or above, whereas in an associate company it will be starting from 20% and above. Another company has significant influence through control of at least 20% of its share capital or voting power. Section 8 company is another type of company which can be limited by shares or guarantee. It can be with or without share capital, but its objects are specifically promotion of art, science, sports, religion, charity, environment, etc. Second, it can apply its funds only to promotion of such objects, and that company shall not pay any dividend to its members. One person company is formed by an individual. It's a private limited company. Although private limited companies need 2 people, for OPC, 1 person is enough. He has to fulfill a condition of natural person, Indian citizen, resident in India, staying here not less than 182 days during the immediately preceding financial year. An OPC is a privilege, but that comes to an end when its paid up capital exceeds 50 lakhs or its average annual turnover exceeds 2 crores, and it shall cease to be an OPC once these 2 ceilings are touched. Then it has to be converted into a regular company.